Wait, let's unpack this. We are diving deep into a stock that is, just giving everyone whiplash right now, SOFI.
Absolutely.
Because on the surface, you look at the headline, and it seems, well, boring. The stock was only down a tiny amount, like 0.18%.
Right. A nothing day, you'd think?
Exactly. But what happened underneath that headline was, it was an absolute battlefield.
Yeah.
The stock swung so violently between a critical low of $26.20 and a high of $27.50.
And that swing, it really demonstrates this profound internal conflict among the major players,
It really does.
And it was a fascinating, if a very confusing day of trading. And to really understand that battlefield, we have to look at the volume.
Which was low, right?
Very low. We saw only 42.9 million shares traded. Compare that to the recent average of 71 million.
Wow.
And that lower volume just amplified all the conflicting signals we were seeing. So our mission today is to really cut through that noise and this intense, almost perfectly split sentiment to figure out why big money is so torn on this company.
Is this a real, legitimate reason for fear?
Or is the technical setup telling us this is precisely the opportunity to, buy the dip, which some of those buyers clearly believe?
That tight trading range on low volume, combined with those wild price swings, it tells us one thing right away. Every single move was being intensely debated.
Yeah, fought over.
So let's start with the forces completely outside of SoFi's control, the macro environment. Because there wasn't a ton of new data, but what we did get was incredibly inconsistent.
Specifically from Federal Reserve Speaker Golby. And what's really instructive here isn't just what he said, but the immediate contradiction in his message.
Okay, so what was the first part?
He began with a projection that sounded very dovish. He was suggesting more rate cuts than the median forecast for 2026.
And that's the kind of forward-looking optimistic signal that the market just loves.
It's exactly what it craves. It points to a healthier, cheaper lending environment down the road. It should have been a boost for growth stocks.
Especially fintechs like SoFi that, rely on lending margins and consumer credit.
Exactly. But then, and this is the key part, then came the pivot, the whiplash.
Almost immediately.
Almost immediately after offering that optimistic forecast, Golby starts emphasizing the critical need for the Fed to maintain its independence.
And he specifically warned about what?
He said monetary policy must be set without political interference. And the implication there, it was pretty clear he was pointing toward potential shifts or pressure from, future administrations.
So the Fed is saying the long-term outlook is good, and then immediately follows up with, but we might face short-term political chaos that could derail everything?
Yeah.
How do investors even synthesize that?
Well, the interpretation boils down to profound short-term caution.
And that just overrides any long-term optimism.
It completely overrides it. The message is basically, we will be cutting rates, but don't anticipate any movement soon. This kind of mixed message, it just breeds hesitation. Institutional traders step back.
And that explains the lower volume and that tight, choppy range. So that internal Fed debate didn't help momentum at all. But then you had these significant ripple effects from other big corporate earnings reports.
Oh, absolutely. They essentially injected this sector-wide fear into the trading day.
You saw concerns about margins, about growth?
We did. And while some fear from Oracle's earnings was still lingering from Wednesday, the real pressure point was Broadcom.
That was yesterday after the close.
Yesterday after hours. And Broadcom, which is a huge player in tech infrastructure, was down a massive 12% today.
Okay, so here's where we need to connect the dots for everyone listening. Broadcom is a chip maker. SoFi is a fintech lender. Why should Broadcom's problems cause SoFi stock to sell off? What's the link there?
That's the critical link.
Yeah.
Broadcom's specific issues were around gross margins and supply chain constraints.
Yeah.
And when a massive tech company like that warns about margin compression, it raises a huge red flag for the entire growth sector.
For everyone.
For everyone, including fintech. Institutional money just interprets this as systemic risk. If core parts of the digital economy are getting their margins squeezed, it suggests a broader economic softening.
Which then translates directly into fears about loan performance, credit risk, and, the profitability of a lender like SoFi.
It's fear by association. Simple as that. Driven by big sector-wide liquidity moves.
So SoFi is getting hit by macro policy paralysis and a fear that economic pain is trickling down everywhere.
Yeah.
That's a huge headwind.
A very significant one.
So let's pivot to SoFi-specific details, or maybe more accurately, the surprising lack of them.
Indeed. I mean, given all this macro volatility, the internal information vacuum for SoFi is just remarkable. We saw absolutely nothing material today.
Like no SEC filings.
No SEC filings, no press releases to reassure anyone, no new speculative topics, and maybe most critically, no new analyst ratings to guide sentiment one way or the other.
And that silence, that itself becomes a catalyst, doesn't it?
It absolutely does. When there's no fundamental news to hang your hat on, that indecision just forces traders to rely solely on the macro headlines and the technicals.
Which naturally just cranks up the volatility.
Precisely. And that lack of internal news, it creates this predictable pattern that the source material really highlights.
Which is what?
When SoFi starts to turn just a little bit bearish, you see this cohort of skeptical analysts. They seem to capitalize on it. They emerge to issue these big sell ratings.
Which just accelerates the selling momentum. It gives a fund manager who's already nervous an excuse to just cut risk before the weekend.
It does. And the expectation going into Monday is that we might see one or two new negative ratings pop up.
So that's adding a layer of anticipatory fear. People are selling today because of what might happen on Monday.
Exactly. They're not just selling because of Broadcom. They're selling in anticipation of those critiques hitting the weather next week.
Now, we have to contrast that bearish feeling with how SoFi actually performed compared to its peers. Because despite all that fear, it only fell 0.18%. How did the competition do?
Well, the comparison shows a surprising resilience for SoFi, really. Robinhood, a major competitor, was down 3%.
Okay, that's a big difference.
And Webull, another significant player, was down 5%. These are much, much bigger drops than SoFi experienced.
But wait, the peer comparison has this one enormous anomaly that we can't just gloss over. Upstart.
Yes.
Which analysts see as the most direct comparable in the lending space.
Yeah.
It was shockingly green. Up a massive 49% today.
An unbelievable outlier day for Upstart. And that was driven by very specific internal company news that didn't apply to SoFi, but its performance is extremely instructive.
How so? I mean, doesn't that fundamentally undermine the idea that the macro environment is crushing all fintechs equally?
That's the question. What does a 49% rally in your closest peer tell you about SoFi's own non-macro weaknesses?
It tells you the fear is highly selective. Or maybe that the market sees unique risks in SoFi that it just doesn't see in an Upstart right now.
It certainly makes that tiny 0.18% drop look minor when competitors are shedding 3% to 5%.
So SoFi is, I guess, holding up fairly well compared to those that dropped.
It is, but it hasn't found its own narrative yet to really fight off that macro fear.
Okay, let's dig into the short interest data, because it seems like even the dedicated short sellers are completely conflicted here.
They are. The short data paints a perfect picture of this institutional indecision. Short interest is, in fact, increasing. 150,000 shares were added today.
And what's the total?
It brings the total shorted float to 9.8%, which is about 115 million shares. But there's just no consistency.
What's the pattern?
They'll add shorts for 2 or 3 days in a row, then they cover and return shares for 2 days. It's back and forth.
So what does that behavior suggest to you?
It suggests they aren't deeply convicted about an immediate collapse. Instead, it feels like they're using short positions as more of a strategic, short-term hedge against macro shocks.
So it's not a full-on directional bet against the company's fundamentals.
Exactly. It's the ultimate hedge against macro risk.
Yeah.
You bet against the climate without, burning the boat on the stock itself.
Okay, let's transition to our final segment, the deep dive into the technicals and the trading dynamics, because this is where the stock was really defined and, frankly, saved today.
It really was. So looking first at the options landscape, the overall dollar value was low, which signals a cooling of enthusiasm.
How did it break down?
We saw about $29 million in calls versus only $11 million in puts. But crucially, net premiums, so the cost of buying the options, they decreased by about $1.8 million.
And a decrease like that means demand for immediate risk, especially on the upside, is just fading.
It's diminishing, yeah. It reflects all that negative sentiment filtering in from the macro picture. And mirroring that, 46% of the options traded today were explicitly bearish.
So you have this targeted selling pressure in the options chain, which makes the closing price for Friday absolutely critical.
It's all about the open interest goals. The options expiration for today meant that certain price points had this massive gravitational pull.
And the target was what, between 27 and 27.8?
That was the anticipated range. And closing above $27 was key. The reason that price is so important mechanically is if it settles above $27, it triggers 7,000 contracts of open interest.
Which means a lot of capital tied up in calls would expire in the money.
And the market makers who sold those calls are forced to hedge them, which can exert upward pressure right toward that critical threshold.
So now we get to the core conflict, the big money volume. If the shorts are hesitant, the institutions are just out there battling each other.
They really are. The observation from the source material is that big money is very torn. It's showing massive inconsistency.
How so?
When we look at the trading volume, it's split almost exactly down the middle. Half of the volume consists of buys executed at the higher ask price.
And the other half is sells at the lower bid price.
Exactly. I mean, you can't get a clearer indication of a deeply divided market than that.
So it's institutional traders generating most of the volume, and they're literally arguing over the fair price in real time. One side sees macro risk and sells, the other sees fundamentals and buys the dip.
That is the battle. They are totally conflicted. And we should also note that the dark pool transactions, those are the big institutional trades off the public exchange. They weren't very significant today.
The largest was what, 1.5 million?
That's it, which confirms this fight is happening right out in the open on the major exchanges. And that's why the stock was so volatile within that tight range.
This internal tug-of-war could easily lead to a massive sell-off.
Yeah.
But the technical support structure is what truly saved the day.
The technical analysis is undeniably the hero of this trading day. The stock bounced, and I mean, it bounced exactly off a very strong support level.
Which level was that?
The critical level was the S2 support at $26.22. For those who aren't familiar, S2 is a technical level calculated using pivot points, and it represents a statistically strong line of defense.
And a bounce off S2, especially after a macro fear event, that shows real resilience.
It shows true technical resilience. If that $26.22 level had broken, what would the downside have looked like?
Well, the source suggests things could have got very out of control. The next major support level was far, far below.
And throughout the day, the stock was also flirting with the S1 support level, which was closer to $27.04. The fact that it held the S2 line and then rallied back, it shows you that buyers were setting firm limit orders right at that level.
So beyond those immediate support levels, the stock is also dealing with major resistance from its own trend lines, right?
It is. It did manage to fight back and get above the 100-day moving average, which is a positive sign for the long term. But it is currently stuck between this wedge of the 50-day and 100-day moving averages. The stock price is just being compressed, waiting for a definitive catalyst to break out one way or the other.
And that compression just reinforces the institutional indecision we've been talking about.
It's a perfect visual of it.
That technical compression, combined with the recent price action, has pushed one major momentum indicator into a really fascinating zone. The stochastic RSI.
Yes, the Stochastic Relative Strength Index. It's a momentum oscillator, and it's currently sitting at 31.
Which is technically considered very oversold.
Very oversold. When a stock is driven that low by volatility and generalized fear, it means the price has moved way too fast relative to its internal momentum.
And historically, what does a reading that low suggest?
Historically, it suggests that a natural snapback, some upward momentum, could be in store over the next few trading days, just purely driven by technical forces correcting that overreaction.
So when we put it all together, the macro fear, the technical resilience, this profound institutional indecision, what does it all mean? We're left with this powerful duality. On one hand, you have a technically resilient SOFI. It bounced precisely off that critical S2 support at $26.22. It held up better than its major competitors. That suggests some underlying strength.
But on the other hand,
it is trapped between those key moving averages. It's subject to major external macro fear from the Fed, from Broadcom, and you have this near certain threat of new negative analyst ratings coming next week.
Right. And to sum up that institutional confusion that drove the whole day, the volume was there, but the sentiment was perfectly split. Equal buys, equal sells, just highlighting total market indecision. The battle is real.
Absolutely. The decision makers are looking at the exact same data and drawing completely opposite conclusions.
Which leaves us with this provocative thought for you, the learner, to chew on. Given that institutional volume is high but fundamentally conflicted, and that technical indicator, the RSI at 31, is signaling the stock is now oversold, which force is most likely to win this battle next week? Will it be the broader macro environment and external fear, the expected negative analyst ratings, or that technical rebound supported by the oversold signal that finally breaks SOFI out of that 50 and 100-day moving average wedge? Something to consider as you review the sources and strategize your next steps.